The broadcast is now starting. All attendees are in listen-only mode.
Good day, traders, and welcome to today's webinar, using points of confluence for trade setup. So my name is Nenad, and today Chris and I together, we will show you how to find these spots and how to actually find those good setups. So before I start, let me tell you that this is basically a bit subjective topic, because in order to trade price action, you can of course use a lot of different indicators, but also have in mind that reading the indicators and reading the price action is indeed subjective. But we will try to explain the basics of it, and uh, well, if you're experienced trader, then definitely using these different tools for POC zones will be very useful, even if you are, as I say, experienced trader. Before we start, CFD and Forex are leveraged products and can result in losses that exceed your deposits, and those are not suitable for everyone. And this presentation and video is for information and educational purposes only, so please read the full risk disclosure on this web address. Why do Chris and I trade with our markets? Because, well, we've been a long time admiral market traders, excellent TNS offerings, excellent spreads, excellent order sizes, account safety with negative balance protection, and everything that is very useful to you as a trader. Also, have in mind that all information on admiral markets you can find on this web address, admiralmarkets.com. Now, today's agenda for my part is defining the POC zones, advantages of trading in the zone, and how to find the zone. So first of all, let me tell you that the POC that you usually see on my analysis, it stands for the point of confluence. So that is the zone where we expect the price to react. In a literal sense, it is the actual entry zone. So basically, that is the zone where we place our entries. Also, it's the confluence of important technical tools. And all of those important technical tools you can find on my price action trading school series that has been uploaded to Admiral Markets YouTube. Now, it's very important to say that trading in the zone uses, well, Camarilla or your preferred pivot points. It uses patterns, EMA 89, trend lines, Fibonacci tools, ATR, order blocks, and historical versus now moment concept. When you put all this together on chart, you need to find the zone that has the most chance to actually reject the price. So by using all these technical tools, I'm comparing price in the past and price in now moment to see where the price can actually or might actually reject. That is very important, because if you don't compare the price of historical price action to now moment price action, the chance is that you might not get any good entry. So it's of utmost important that you find all these potential entry points also in the past, because in forex market and generally, let's say that price tends to repeat itself. So it's very useful, and that historical and now moment concept is one of my trademarks. All price action knowledge should be combined in order for you to see the zone properly. Zones are very subjective, so it means that if I see the zone, it doesn't mean that you will also see the same zone yourself. So It requires a lot of screening time. It also requires a lot of trial and error. But once you master it, you will be actually, I think that you might become a very good trader. Chris and I, for example, we keep a lot of statistics in the market, really. And we keep statistics of our trade setups. We keep statistics of our trading ideas that we both trade. And let's say we trade it on our Telegram channel. We trade it after we post the analysis on Admiral Markets website. So what we analyze, we also trade. And for example, this is just a snapshot of our last trades that happened after the new year. So you can see here we had 6 of 6 wins by actually using this approach. The POC zones that are my own method of finding entries with my Camarilla MACD system. Chris also uses his SWOT method, and those two methods are complementary because Camarilla MACD is intraday method while Chris SWOT method is a swing method. It means that with swing setups, you can capture more pips per trade. With intraday setups, you capture less pips, but you have more chance to trade. But the end result is the same. We are there to make pips. So trading in the zone for me is of utmost importance. If I don't see the zone, I definitely do not trade. I skip a setup. It requires a lot of practice. It requires a lot of screening time. And actually, when you trade in the zone, you're weaving a story of price action that happened in the past and that is happening in the present. Because when you open a chart, you will always see different patterns on your chart repeating all over again. Because of that, guys, forex trading is very, very, very unique experience, and it is indeed, well, I can say, very subjective. Now, for example, why do I say weaving a story? Because every single chart and every single time frame has its own trend. For example, pound dollar. This is uptrend on 5-minute chart. If you go to 15 minutes, you will see a sort of downtrend. If you go to 4 hour, you will see a trend again. So it's good to know, and it's very important to know that every time frame has its own story, has its own trend. Without using these Confluence tools, well, I think that you will be mostly trading indicators and trading pure indicators without any knowledge of trend lines, Fibonacci, momentum and trend, price action. I don't think that you will have a big success. Of course, most of success from forex trading comes from actually correct and excellent money management. But if you don't know a lot about money management, you still can make some bucks, some pips out of the market if you actually have let's say 70% of success when entering a trade. Greg is asking, will this process work well with futures and stocks? I need to say that I don't trade stocks, I don't trade futures, but I trade equities and I trade commodities. And when trading equities, it's not like forex market. It works, but it requires also a help from, let's say, other tools such as EMAs or let's say trend lines. But I also do use trend lines. Maybe in equities trading, I would say that it requires a bit more trend lines than forex market because it's not that the price is repeating itself like in forex market. In commodities, it's similar, at least for oil, WTI, and gold. but in Forex market, it's the most pronounced. Stocks, unfortunately, are very subjective because one single rumor can wreak a havoc on your stock. But on equity, and equity is actually index, and indices are group of stocks. It works, of course, because price action works on every market. I don't know about futures, but for Forex indices and commodities, it works. I need to tell you guys that also it works for cryptocurrencies. But unfortunately, cryptocurrencies has not been implemented fully yet. But as soon as as soon as we have regular trading conditions with cryptocurrencies, with not so big, huge volatility, I will show you how we can actually trade also cryptos with this approach. 6 of 6 my trades on demo account on cryptocurrencies actually came in profit by using the same approach I've been doing with my Camarilla MACD on Forex, commodities, and equities. Now, it's very important that we have prediction and reaction. When I make an analysis, it is prediction. When the price comes to my POC zone, or when I see, let's say, some important points of my Camarilla MACD system that tells me that this is a potential trade, then I make a reaction. Prediction and reaction should lead you to profits. Buffer zone for my entries is usually 10 to 15 pips. When I say, for example, I have a buy trade, I will always have, let's say, 10 pips of that buffer zone if the price gets a little bit deeper into the zone, so I can actually scale in a trade. So, for example, what it means is if, let's say, if we have the zone and this is the zone, and let's say this is 1.000 and this is 1.010. So this is like 10 pip of a buffer zone. So as soon as price enters the zone, let's say with my MACD, I can wait for a signal. I always wait to see if the signal is valid. If it is, I can enter with 0.25 lots. If the price proceeds further in the zone, I add 0. Let's say 25 lots, keeping my risk not higher than 2% of trade. And I never move my stop loss because stop loss is predetermined before you actually start to trade. You always need to preemptively calculate your stop loss because you're not trading the price in a sense how much you want to make. You're trading the risk. So it comes and it boils down to how much you are willing to lose. That is why the primary thing when defining the zone is define the zone, define the stop loss. And when price enters the zone, you can scale in, you can add to your trade, and you don't move your stop loss. Sometimes it will happen that price gets in the zone, but it doesn't get further in the zone. It is rejected instantly. For example, it happened today with my euro dollar trade. I traded euro dollar and my zone was 20 I think it was 2030 to 2040, or it was 2035 to 2045, and my stop loss was 2015. And when the price entered the zone, well, I entered with slightly higher. I entered with slightly higher with 0.5, but I wanted to add 0.25 if the price actually retraces deeper in the zone. But it didn't retrace, and what I got, I ended up with 0.5 lot trade. But as I say, still it was good enough for me because I was happy with how the trade actually developed. I closed my profits completely, and well, you see, it's very good tactics if you have the patience to actually wait for a price to hit the zone, wait for maybe a deeper retrace in the zone, and then add. But you need to trade with your risk boundaries, and your risk Well, if you're an experienced trader, 2% per risk per trade is okay. If you are not experienced, 0.5% is okay for you to start trading. Also, as I said in the beginning, there are intraday and intra-week setups. My Camarilla MACD is intraday setup method, while Chris's SWOT is intra-week swing method. Every single zone on POC zone is based on strong premises. It means that both of us use the tools that are suitable to their respective methods. I use MACD, I use trend lines, I use Camarilla, of course, pivot points, 1-2 patterns, tops, breakout, double tops, double bottoms. While Chris uses his EMA, his favorite is EMA 144. He also uses awesome oscillator and a few more indicators that are very suitable for his SWOT method. So basically, guys, when you want to make a system, when you want to make a confluence, you need to have a set of tools that works the best in your trading approach. That is why I say trading in the zone is crucial, but you need to find your own set of indicators that can help you define the zone. Or you can use our methods that we both trade, Camarilla, MACD, and SWOT, to actually find some, maybe, well, you can follow our trading ideas. It's still okay. We do our, as I say, on Telegram, we also have live webinars with Admiral Markets, real-time trading ideas, so you can always follow our setups. But the most important thing, we give you the knowledge to form also your own POC zone, because POC zones are always subjective. And what works for us, well, maybe it's not your trading style. Maybe you want to actually trade something different. That is why you need to have a knowledge what the POC zone is. And let me tell you that banks also use the zones. The banks might not use the term maybe POC zone, but the term they use is connected to the zone, and usually it's confluence points, confluence zones, or something that has a single sentence or word inside it. It's a confluence. Confluence is very important. It's I mean, the only way I can trade the price successfully, at least how I find myself, how I find my trading, is when the price gets to the zone, I wait for a signal and I assess a signal as a trader. Okay, I need to assess a signal that my system gives me as a trader. When I make the analysis, I always watch the zone when price comes in, and if I'm pretty sure that price will reject, I enter a trade too. But it's prediction. Reaction, as I say, is something different. And my method and Chris's methods have more than 70% of success rate with trading ideas that we actually give. Well, sometimes on my account, I can let myself do more trades. You know, guys, I'm a full-time trader, so instead of making 2 or 3 setups per day, I can make 5 setups. 3 setups are public, 2 setups are just for myself. You know, it's like I can do whatever I want with my account. But if I give you a trading idea or analysis, I really need to take care of that, right? So once you make profits, it's enough. Okay? You don't need to rush in for more and more trades. But as I say, it always depends on your risk appetite. If you want to risk more, then you can, well, trade every single signal that your POC zone gives you. But as I say, try not to do it, because over trading leads to a lot of self-confidence, and huge self-confidence can actually bring so-called a night of trading apocalypse. It's called greed. When greed comes knocking at your doors, well, it's the first step of losing a nice chunk of your account. So do not be greedy, guys, please. Disadvantages for trading the POC zones. It's not for everyone, definitely, guys. As I say, there are different types of traders. Some traders prefer price action, unfortunately, some traders think that just by using indicators, they can make money in Forex market. As I say, most of the time, you will be making good money, or good money. It's still subjective. What means good money? What is actually good money? But you will be having like 70-80% of chance with approach that Chris and I use. But still, if you over risk, you can actually make 7 trades that you want in succession. You can kill it with a single losing trade if you use bad leverage. Leverage is great. It's there to help you out. I personally use 1 to 500 leverage, but it's there to help me out, guys. I'm not misusing it. I actually use the leverage to help me out in my trading decisions. And it's always good to know that you can use the leverage to your advantage. But as soon as you start overusing it, like putting a huge risk in a single trade or revenging your trade, it's not a good use of leverage, and the chance is that you will lose a lot on your account. It takes time to develop a habit for finding confluence zones. This might be a completely opposite to what you used to, because usually traders wait for a signal of, I don't know, EMA cross or stochastic cross, whatever. Well, this is a little bit different, especially when it comes to price analysis. It has a learning curve, and there is no expert advisor for my Camarilla MACD method, and there is no expert advisor for finding the zones, because you need to assess every single trade as a trader. For me, personally, this is a benefit, because whenever I get a signal from my Camarilla MACD, I take a look at it, and as a trader, I want to see if the signal is valid or not. You know, guys, systems methods are there to give you cues where the price will go. But you actually use the risk and price section for your entry. So the analysis and trading decisions, it's not the same. I'm helping you with the analysis to find the POC zone. But you need to make your own trading decision. Will you trade the zone? Will you enter the zone? Or will you actually skip it? Yesterday on my trading webinar, Wednesday live trading ideas with iron markets, I made a good trade on dollar CAD. But I also said the WTI, you should watch for divergence and reversal patterns within the zone. What it means? It means that if the price gets in the zone and you see that you want to trade counter trend, especially if you go counter trend, you need to have other tools, guys, for trading counter trend. You cannot just put a sell because it's a zone. It's a zone, but what makes the zone valid? A bearish rejection candle, a divergence, right? Or maybe there is something else, like, I know, a range bar confluence, something that you find on your own. But trend trading types and counter trend trading types are different, guys. So for counter trend trades especially, you need to have additional filter, and it's usually divergence, usually. Okay, now let's skip to live chart, and we'll give you a few examples how I find a zone. Then you can actually use it. You can listen to Chris later, so he will explain also his approach. But let's say, for example, guys, let's take a trade on we can do GBP dollar, for example, an example. So I always watch for higher time frames first. So let's say that my favorite time frame to start, let's say, multiple time frame approach is daily. Daily is uptrend, obviously. 4 hour is having a retracement, right? So if I see that daily is up, I drill down to 4 hour. If daily is up, 4 hour is up, then I drill down to 1 hour time frame. And guys, here, obviously, we had a good confluence within the zone. Why? Because daily was obviously in uptrend, defined by MACD and price action, high, low, lower, higher, low. This is another higher low. Then we have a high. Then the price consolidated, but it made a double bottom, then another higher high. So all of this, high, low, trust pullback, following DMA, trust pullback. Well, W lean. You see, a lot of these things are happening simultaneously, guys. W pattern. Watch this, guys. Now I didn't cherry pick this. I just opened a random chart. I didn't prepare the chart for this webinar. So I will, when you have the experience in analysis and trading, it's like you can spot it almost instantly. So watch this, guys. This is W pattern, right? Leaned W pattern forming up. It's also a form of ascending scallop from this point. Ascending scallop. Watch this. Okay, scallop. Then you have inverted head and shoulders here. Okay. Then you have trend line breaks. Then you have a history of highs and lows. Higher lows, higher highs. Higher lows, higher highs. And so on and so on. Watch this. Obviously, this is uptrend. Previous 3, 4, 5 candles are bullish. So just a pure logic. And MACD is tick bullish. You see? It's tick blue. It's bullish. So just logic tells you that this is definitely uptrend on daily. On 4-hour, the price is retracing. So you can pull out Fibonacci from the previous swing to this swing, most obvious swing, and you will see it's actually here. You see, it's 61.8. It's weekly Camarilla, and what is very important, guys, you also have an order block here. This is an order block, okay? And the price came down, but when it went up, it actually retested this spot and went to the upside. So it's telling me that this zone is actually good for a potential rejection, and it actually happened. You have a trend line here also. So a lot of confluence here, guys, and previous highs were actually broken. Also, if you know about Camarilla, price is above monthly L3, right? So it's still inside of the range, but it broke monthly H3. Usually when monthly H3 is broken, price comes down, retests this level, and it goes up. So if it went below here towards L4, I would say the price is bearish. But this is another confluence. So a lot of confluence here, and clear sign that GBP dollar should have rejected from this spot. Let's pick, I don't know, let's pick, for example, random, Australian dollar yen. Similar things. This is V-shaped reversal. Huge uptrend. You can always place ascending trend lines, multiple trend lines within the same chart. Then you have a huge, well, this is a nice retracement. Let's see a daily chart. Obviously, W pattern and a lot of bullish candles. Wow, this is definitely strong uptrend. Price is losing a little bit steam because it's thickening histogram, but it's blue. If you go to 4-hour time frame, you see the price actually made a retracement here. On daily chart, the price was thick blue. On MACD, it started to thin, but it is bullish. Here, there was consolidation, and the price went down. Just pull a Fibonacci here from, let's say, previous most important swing. It could be this one, okay, towards this level. And at this time, the price actually rejected from weekly L3. In Camarilla analysis, weekly L3 level, weekly H3 levels are important. For placing long trades, it's usually very good to wait for weekly L3 because usually then, especially during holidays, the price will reject from weekly L3 towards weekly H3. In standard pivot point trading, guys, you don't know. It's not. Standard pivot points are not the same as Camarillas. And guys, this is order block. You see here, almost triple bottom. And always double bottoms and triple bottoms are always good order blocks. Price went down, retested this. We had historical buyers here. Always check your chart for historical buyers. A lot of buying in the past. You see? So it was obvious that the price could have rejected from this point. So once more, guys, when you want to find historical buyers and sellers, flip your chart to the left and see whether the price rejected from the same or similar spot in the past. If it did, there is a big chance that it will reject again. So yes, this is recorded, this webinar, Ilya, and hi to you. Now Chris will continue, guys, and of course, if you have any questions, do not hesitate to ask me. But have in mind that it's always a good thing to watch at the confluence, not just a single indicator such as MACD or stochastic, whatever. You need to find a confluence, and this is, for me, this is the best way to find confluence. Watching higher time frames, comparing lower time frames, and finding all these important spots that we mentioned in price action trading school, or that you can incorporate into your own trading method. Thank you guys for listening. We'll be here with you soon. Now Chris will continue.
Hi traders, here I am. Sorry for that. We're going to continue indeed. Thanks so much, Nenad. Yes, Confluence's
Let's wait
points
for Chris to join. I
should
think
be here.
he is there, but
Nenad, do you
not
hear me?
sure that I see him. So guys, it doesn't matter. We will wait for Chris when he comes back. Until then, guys, do you have any other questions? Okay, Chris is here, but I can't hear them. So yeah, okay, great. I actually couldn't hear Chris, but I see that my headset is not connected with speakers, so that is the reason I don't hear Chris. Thank you, guys.
Okay.
See you soon.
No problem. Great. So hopefully the audience can hear me. So yes, Confluence's point of Confluence is, let me switch the microphone here. I mean the screen sharing, and let's take a look at my charts. All right, there we go. So yes, Confluences, I recommend basically different categories. So you have, with support of resistance, obviously, as Nenad already explains very nicely in his presentation, basically you're looking at round levels, tops and bottoms, fibs. Those are all, any support of resistance level in general could aid to understanding where's Confluence. Confluence is multiple points in around the same zone. It doesn't have to be exactly this price level, but you know, if there's a 120 round level like with the euro dollar and there's a fib, even if the fib is 10 pips lower or higher, you get the point, right? It's about the zone, not really necessarily exactly to the pip. That, you know, how much difference could there be depends on the time frame. On a daily chart, even 25, even 50 pips is really relatively close. On a lower time frame, if you're looking at an hourly chart, obviously 5 pips, 10 pips is give or take is a zone of confluence, not if there's a 50 or 60 pip difference, because that's already a pretty decent space between those supportive resistance levels. So confluence, we're looking for multiple things, right, with regard to supportive resistance. The more, obviously, the more confluence, the stronger that supportive resistance is, the higher the chance is that there's going to be a bounce, right? So for instance, let's take a look at the daily chart. So when price was approaching right here, right, we were already indicating that at this point, let me put a vertical line, that there could be a bounce in this zone. There's a 120 round level, price is approaching again these tops. There's a Keltner channel, for instance. Those are just a couple of things. I think that if I remember correctly, and we put a fib from here to here, no, in this case, kind of missed the 78.6 fib. Well, it was relatively close, right? So, but you get the point. There are a couple of things there. Obviously, the more there are, the stronger that zone is. If there's only one or two things and price action is looking strong, then a breakout could occur above that confluence zone, right? So breakout occurs when confluence is weak and price action is strong. Bounce or reversal occurs when confluence is strong and price action is relatively weak. Also, if there's divergence, for instance, if there's divergence between these two tops and price is approaching a confluence zone, also a reversal or bounce is more likely. So this equation of price action, how strong is price action and how strong is the confluence, That will determine if there is a breakout or bounce. And that does vary a little bit. This is a kind of a rough formula that will depend from case to case. Each case is a little bit unique. That takes a little bit of experience to kind of get an idea like, well, am I looking for a breakout or a bounce? But I think that's pretty much, with some experience, you'll get the hang of that and it will get better to judge that. That's basically the equation. The point of confluence is an important part of that equation. It's half of that equation, isn't it? Right? So it's very key. Now, I recommend taking a look at 3 different types of support or resistance. On higher time frames, I look on daily time frame in my case, but for other traders that could be weekly or monthly. I look at fibs, tops and bottoms, round levels, and Murray math. All right. So once again, tops and bottoms is quite, logical, not so difficult to incorporate. Round levels, pretty straightforward, isn't it? 120, obviously, etc. Even quarter levels. But fibs and Murray math is maybe something that is maybe something you don't incorporate. So I use those 2. Murray math is, I'll just show you the Murray math level. I don't have it in this technical template. Let's take a look at, and by the way, the Keltner is something I always, not always, but on, let's say this way, with this particular template, I do look at it on all time frames. All right, so it's something that is also an extra Confluence. Pivot points, I don't tend to use on daily chart. That is more something I use on 4-hour charts. All right. So Keltner, fibs, and Murray math. I'll just quickly show you Murray math. This is Keltner channel, by the way, as you can see. These light purple lines and blue line. That's part of the MT4 Supreme, or it's not only MT4, by the way. It's the MetaTrader Supreme Edition, MT4 or MT5, I should say. And this is one of the extra features there, as we mentioned before. There are a ton of extra features, including this pivot point and mini terminal. So, but I wanted to show you the Murray math very quickly. Let me show you. Let me think. There we go. It should be on this template visible. Wrong. It's a different one. There we go. What I like about Murray math is that it's based on fibs. It's based on octaves. And I like the principle because you can see in other spheres, like music, for instance, other areas, that they have a similar kind of interesting. They have a work well too in how music behaves and stuff like that. So I think it's very useful to rely on Fibonacci levels. You will see Fibonacci levels in very many different aspects return in my trading, at least. Not only do I use the fib retracements and fib targets, I also use Fibonacci sequence levels for targets, really literally the pips that are counted and how much price moves. Very useful for identifying spaces. I use fib numbers for moving averages. I use fib numbers for time patterns, and I use the Murray math level, which is also based on fibs. So I'm a little bit of a Fibonacci, I would say, fanatic, I guess. But well, what can you do? And waves, of course, are also fractal nature. That's also related to fibs. So yeah, that's just my trading. But I'm just sharing you what I like. Of course, what you should do is find your own, fine-tune your own kind of style, obviously, and find what works for you. But the main message is that on a daily chart, choose a couple of indicators that you like to work with. Try to understand where the big stopping spots could be. So that's what I'm trying to do with me using Murray math levels, fibs, and round levels, tops and bottoms, and Keltner. All right. So I'm trying to see where are big levels, where price could turn, and if price does break through a big level, what will be the next point of confluence, right? So with For instance, the Murray Math level on the euro-dollar daily chart, we can see there's a confluence level here, 115, 116. We talked about it already, right? That there could be a bouncing spot. Not only is it close to Murray Math level or at Murray Math level support, there's a long-term moving average. I'll get into that a little bit later because it's not that important for a daily chart in my view, but it's an extra factor. More importantly is this fib that I had on the chart, right? So it's close to the 38 fib. It is close to this minus 272 target, Murray Math levels. So we got fibs, Murray Math levels. I don't have the Keltner on this particular time frame, but I'm sure it was probably bouncing at the Keltner. Round level 115. So yeah, definitely in this zone, we are getting into a point of confluence, and indeed price bouncing nicely to the upside in that particular time, right from this area, right? Just an example. So that's what I like to do is kind of space out, or I should say, understand where the potential spaces are and where the potential confluences are. If price would break through this zone, then the next confluence zone was around 113, 112.50. If we got a bounce, then I thought that the next kind of move up could be up to 119, 120, right? So you can get an idea when price will bounce and if it bounce or break at these confluences and what the next confluence could be. All right, that's what I do on the daily chart. Then on 4-hour chart, let's head back. Let's go lower now. So this is generally to map out, is maybe the best word, what the potential is. On the 4-hour chart, I look more at trends, but it's not to say that confluence isn't important. The emphasis for me is on trends, so I zoom in by looking at what the momentum is and where's the trend. And I try to find a retracement within that trend. In this case, confluence is important too, but not as a filter, but as where could price continue with the trend. So not as a bounce or break spot like on the daily chart. So the role is a little bit different, if you see what I mean. For instance, just to give you an example, recent example here, where price was making upside a few weeks ago, and then started to make a flag like this. So where's the confluence that price will turn? So if I remember correctly, I had a fib from here to here. So we see 50 fib, quarter level around 117.50. We see a long-term moving average. We see price moving correctively, just to name a few. So on these time frames, I like to use moving averages. I like to use fibs as well. Again, fibs are always a recurring theme, but definitely the moving averages are very important for me. In fact, my whole trading, not my whole trading system, but a good chunk of my trading system is built on moving averages, not in a simplistic way like what you might learn when you're just starting out, like, oh, I wait for 50 moving averages to cross this one moving average. No, in a little bit more, let's maybe say sophisticated way, and a little bit deeper way, right? As you can imagine, probably. So what I'm looking for is retracements to those moving averages as part of the confluence. Fibs I use on this time frame. I use oscillators to confirm the retracements, and I use patterns as well. Anything else? Thinking if I'm missing something here. Not at the moment. If I think about it, I have a feeling I'm missing something, but it doesn't matter. That's, moving average is a very important part for me on this time frame. And that's about it. That's how I use Confluence. Now, in a lower time frame, I'm looking for entries, right? I can even enter on the 4-hour chart. Sometimes I zoom into the hourly or 50-minute chart to look for entries as price continues. And in this particular spot, Confluence could still be interesting, specifically looking at pivot points, of course. I was already thinking that. I didn't see pivot points because I was looking at historical price. Yes, pivot points, of course, specifically on 4-hour, 1-hour charts, and trend lines, of course. You see now it's flowing. Trend lines, very important too, giving an additional confluence. When I look for entries, I'm actually not looking for Confluence. If I find it, okay, but I'm not necessarily looking for it. With entries, I'm actually looking for one indicator to confirm an entry. So that could be a break of a trend line. That could be proprietary kind of tools I use, like I have my own candles that confirm entries, for instance. But you can just use breaks of moving averages too, or you can use breaks of or bounces at fibs. You can use fibs for entries too. You can use breaks for trend lines. You can use indeed Keltner channel as well, bounces or breaks. So these are but then I'm not looking for Confluence. I'm just actually looking for one trigger point. So that's why I don't, it's just like one kind of, it's like a trigger. So it's not Confluence, because Confluence is, of course, as we said at the beginning, multiple factors coming together. You could still use that for the retracement on the 4-hour chart, but with the entry, I don't need that many things to come together necessarily. Because why? Because we did already the analysis on the daily chart and the 4-hour chart. So specifically the 4-hour chart is more important to me, at least, than the daily, by the way. So on the 1-hour chart, everything, there's already, let's say, a green light. There's already enough evidence for me to say, okay, this is an interesting instrument, and let me look for an entry. If there is not something interesting, I wouldn't even look at the entry chart. So this last step isn't that much of a hurdle, because I already checked whether it's good to go and whether it's interesting on different time frames. Now these are the time frames I use. Once again, that could vary. I'm more of a swing trader. Nenad is more of an intraday trader, or intra-week trader, I should say, for myself. Now, obviously, the same concepts could be used on different time frames. I use 4-hour, main emphasis on 4-hour chart, then zoom into 1 hour and zoom out to daily to check out from a different angle. I mean, if you would be using the hourly chart for entry, I guess you could do the same for 4-hour and check the 50-minute chart, right? Although looking at the daily chart once a day wouldn't hurt in any case, even if you use the hourly chart. But okay, you get the point. You can use the same tactics, but on different time frames. Or if you're opposite, you enter on daily chart, you could check 4-hour and check weekly, right? But main chart for you would be daily, for instance. This is not the Bollinger Band, actually. It's called Admiral Keltner channel. It's a Keltner channel, but this particular one is Admiral Keltner channel. Excuse me, and it's part of the Supreme Edition that you can find. It's a plugin, actually, that you can find here. Just go to admiralmarkets.com, click on Platforms, and click on MetaTrader Supreme Edition. It's not only Keltner, there are 60 extra features, and I'm pretty sure that if you like the Keltner, you'll find others that will benefit your trading. So definitely check it out. You can find it right here. I personally like Keltner a bit more than others because it's less expansive in its movement. But obviously, this is just my personal opinion. And this is something you can test yourself, of course, and find out which one, if you like any, and which one you like more. I personally like this one because it shows bounces better, in my view. It's not that it doesn't respond that wildly as the BB, because it kind of, in my view at least, tends to kind of almost exaggerate in its movements only when there's a volatility breakout. I like this more. All right, so now which tools you use? Obviously, you got to fine tune that yourself. Choose the ones that make sense. I wouldn't go too overboard with looking at 20 of them. It kind of makes things too clustery, too full. You might get a situation that you're overanalyzing and no space will be visible. So you want to be careful with that. So you want to find a balance, I think, and find the ones that suit your trading, suit your style of trading. Any questions at this point? Which support or resistance tool or indicator do you prefer? What is your favorite one? Let's see, just like a sample, like a poll, small poll. Which is your favorite support or resistance indicator or tool? It doesn't have to be the ones that I mentioned, of course. It could be anything. We got a big group today, so let's see if we can inspire each other to see if there are anything else that I didn't mention that you might be looking at or using often. So we get a representative idea a little bit maybe about what is mostly used. All right, so once again, what is your favorite support and resistance indicator or tool? What is your favorite support and resistance tool or indicator? That's the question for you. Let me know in the chat what you think is the best. Now, if you ask me, obviously, maybe you can guess already. But my favorite one is let's say the general Fibonacci concept, because everything from a lot is tied to fibs in my case. All right, we got some answers coming in, but please join the debate. Yanis is saying Camarilla, and that's a good one. Great example. Indeed, I mean, if obviously Camarilla is a great one indeed, and which pivot point, let's say you use, you can test multiple ones and see which one you like the most. Camarilla is definitely something to think about. Nenad is a big fan, as you can imagine. Andy says pivots and fibs. So we're all kind of thinking in the same direction for the moment. Gabriela says fibs and trend lines. True, trend line, I like trend lines too. Yeah, it's true. I must admit that for me it would be difficult to pick one. Maybe it's a difficult question, but I mean, if I could take a top three, I would be fibs, trend lines, and moving averages. But it's a difficult question because they all have different roles at different times and different time frames. So it's a little bit difficult to say. And Giannis is saying weekly pivot points on 4-hour chart. Yes, I agree with that. I have the same setup actually. Have weekly pivot points on the chart. These are weekly pivot points actually that you're looking at. It's good to 1-hour chart is a little bit small for this pivot point. 4 hours better. I agree. Yeah, there's confluence in our opinions on that one indeed. So yeah, just generally speaking, don't go overboard. Choose the ones that make sense, basically. I mean, I think using that for 2 time frames makes sense. On 1 time frame, look for space, look for filters, be careful of trades. On the other one, look for kind of retracements. Or if you're a range trader, look for areas where range trades make sense, right? So on one hand, it's a little bit of a negative view in a way. On the daily chart, in my case, it's a little bit negative, right? Where could price be stopped in a way? Whereas on a time frame lower in the 4-hour chart, I'm looking like, okay, where could price continue actually? So I use point of confluence in two different time frames in 2 different ways with 2 different kind of ideas in mind. In both cases, I'm looking for areas, zones to show confluence and come together so that there's a higher chance that price will bounce or break. And that's how I analyze the path of least resistance. It's really important. It's like we're looking at a map or the terrain, right? And it shows us what is more likely for price, what direction is most likely for price to go, and support or resistance and confluence is an important part of that equation, as I said. put that together with price action, generally, let's say the trend, and we have kind of an equation, what is more likely. Then if we add patterns to the mix, I don't want to make it too complicated, but if we then add patterns, patterns help because they give us an idea whether support or resistance or trends are going to win out. So if we see, for instance, like let me give you an example on your dollar again, like here, this pattern right here helps us identify that the upside is probably going to help, it's going to be the winner. So the main kind of objects or concepts are trend, let's say price action and trend, versus support and resistance and how much confluence there is. But the third pillar is definitely patterns, because it helps us recognize this balance, this power balance between the two, and which one is going to win. And patterns help us make that estimate easier. So that's how they all three kind of fit together. We can take a look at New Zealand CAD, no problem. There we go. Yes, upside looks good indeed. I agree. I was analyzing this one today, and it does look like a bull flag. And no, I personally didn't trade this one. I traded today different pairs, pound odd, dollar yen at this moment. But I think that pound odd downside and dollar yen upside. Dollar yen is a little bit tricky, but okay. And that has to do with the fact that it's a bit slower pair. But I agree with you. I think that price has definitely made a kind of a falling wedge pattern. There is support, definitely bounced support here, and good momentum to the upside, and it's making kind of this chart pattern like this here. So from my point of view, bounce at the 50 fib, bounce at the bottom of the bull flag, looks like a continuation. But if you look at all these factors together, and it's breaking now. So it's definitely something that was on my radar. And the only reason why I looked at others was I think that they move more fluent and quicker. Yes, I think, but I mean, otherwise I think it makes sense. And this is a pretty good 1 hour candle. 4 hour candle isn't closed yet. So I think that looking at this 4 hour candle could make sense. There could be, of course, depending on how this 4 hour candle closes, if there's a big wick, there could be a little bit of retracement first before you get maybe a new attempt to break out. If this is a good breakout candle, then maybe only a little bit of retracement before a continuation is probably more likely. So this 4 hour candle could be a bit important for that, but definitely in a position that this makes sense as a bullish breakout. Agree. And we might see a little bit of retracement or a little bit bigger retracement depending on how this candle goes, or no retracement, of course, is possible as well. But I think that I would just wait for this. I would personally wait for this. I'm not going to trade it myself, but if I would wait for this 4 hour candle to close and then try to see if it kind of gets a little bit of a correction, probably maybe to about halfway this candle, 50, 61, 78.6 fib zone, and then bounces and continues. I would be inclined towards that. All right, folks. Well, this was the first webinar in, or at least for me, I'm not sure, maybe Nenad had webinars already actually, but first webinar for myself, 2018. We look forward to seeing you with more webinars next week. We're going to have full schedule again with trading webinars and with educational webinars next week. Educational webinar, same time, same place. So looking forward to see you next week. Wish you good trading and talk to you soon. Cheers.